Well, hello everyone and good morning. Welcome to this webinar today, hosted by the Seccl and 11FS team. We are going to review the report that we just launched in conjunction, which outlines how firms can really take advantage of the embedded investment opportunity ahead of us. So there's two parts to the session this morning. First, we'll hear from the 11FS team, who will recap the key findings of the report. So Farah and Benjamin will give us a quick presentation on that. And then we'll move on to a panel discussion where James Holmes, Seccl's Chief Product Officer, will be joining us alongside the 11FS team. And just quickly, before handing over to Benjamin and Farah, who will introduce themselves, there are a few housekeeping points to mention. So firstly, please use the Q&A section at the bottom of the screen. We really encourage lots of questions throughout the session, which we'll get to at the end. So please submit anything on your mind. And if you're watching on your mobile or commuting and you don't have access to the Q&A box, please email your questions to events@seccl.tech. And finally, the recording and slides will be shared after the session. So over to the 11FS team, and we will be kicking off the panel afterwards.
Thank you, Liv, and good morning, everyone, wherever you are in the world. I suppose it might be good afternoon or good evening if we have any listeners from Asia. So I'm Benjamin Ensor. I'm Director of Research and Strategy at 11FS, and I'm going to pass over to my colleague, Farah, to introduce herself.
Hi, good morning, everyone. My name is Farah Ariana. I'm an industry strategist here at 11FS. I'm also the co-author of this report.
So it was a great pleasure for us to work with Seccl on this research, and we're hugely grateful to the numerous individuals who contributed ideas and thinking and examples to the work. So big thank you to them. So what we wanted to look at is what's the opportunity for embedded investing, particularly focusing on the UK, though many of the lessons are also relevant to other markets in the world. What I found fascinating is the sheer diversity of customer behavior. I mean, people are wonderfully diverse anyway, but when it comes to their investing behavior, we see even greater diversity than in other areas of life. And the UK is in a really interesting place because we've got this growth of many new investors, first-time investors coming into the market. And yet at the same time, we have this underinvestment where many people are sitting on savings. And we think one of the root causes is that people need simple guided access to investing, and they don't know where to find that. So we found that the UK is experiencing a substantial growth in investors, particularly younger investors. But many of these people struggle when making investment decisions. I want to be careful of generalizing. There are obviously some highly super confident people who are absolutely piling into particular investments. They're really into Bitcoin or digital assets or equities, and they're really confident. But they're greatly outnumbered by other people who don't have that confidence. And we found that many young investors are making impulsive investment choices. They're not confident. The FCA found that 25% of young investors are making just impulsive investment decisions to keep up with trends. And at the same time, despite this growing investor base, you've got the lowest levels of retail investment in the UK among G7 nations. So we've fallen behind Germany, Canada, the United States, etc. In terms of where people are putting their money, because British people are putting their money into property and they're putting money into cash. And with the change in interest rates, of course, that's a terrible decision because inflation is gradually eating that cash away. According to the Bank of England, there's £280 billion sitting in accounts earning zero interest. According to the FCA, 79% or 4 in 5 of adults with 10 to 20,000 in investable assets are holding all of that in cash. And according to IG, 3 in 5 of those UK savers are avoiding investing because it feels too risky to them. So there's a real lack of confidence among British investors, particularly, but not only younger investors. And so what we think is really exciting is the opportunity for financial services firms and other brands to use embedded investing to address the historically underserved needs of British investors. And we think there's three ways in particular how embedded investing can help. So the first is to give people access to investments through familiar interfaces. Millions of us already use digital banking as well as online shopping and mobile shopping, social shopping, and so on. And yet investments are often come through a separate app with a new company and so on. It's disconnected from people's everyday money management, particularly if you're only saving small amounts. The effort involved of finding an investment firm is substantial. So investments being embedded into familiar interfaces, as firms like Monzo and Zopa are starting to do, opens up a really interesting opportunity to serve people better. The second opportunity is to start bringing down the barriers to investing. When people have to go to a new firm, for very good reason, there are some substantial onboarding processes that take time. There often can be high investment, minimum investment amounts. There can be a lot of jargon, and all of that can deter and put off new investors. It's not easy enough. The opportunity is to really streamline that onboarding, particularly with firms where customers are already registered, already known, have already been through sort of know your customer and anti-money laundering controls and such like. And enabling people to start doing things like making small roundups to make investing easier for beginners. And the third opportunity is to give people better guidance to achieve their investment goals. Some of the regulation in the UK over the past 2 decades has unfortunately been a bit counterproductive, intended to protect people from bad advice. The result has been that actually most people don't get any advice at all. And so people are being offered really quite complex, sometimes quite risky investments, often with inadequate explanation and no real guidance on balancing risk and returns. I'm sure some of you listening, have got a cousin or a friend, who's piled all of their money into Bitcoin or something like that, and maybe done very well, or maybe not done very well, but piling into an asset without really understanding entirely what they're getting into. There was a really interesting change the FCA made right at the end of last year, where they're bringing in a new rule called targeted support that's going to enable firms to offer generic advice to customers. So suddenly, all sorts of firms will be able to give customers more goal-oriented portfolios with personalized insights without having to take on the full burden of providing personalized, regulated financial advice. And so that makes now a really, really interesting opportunity for the UK investing market, because the rules are changing. The rules are being relaxed to make it easier to give sensible advice to mainstream customers. So there's a great opportunity, and I'm now going to pass over to my colleague, Farah, who's going to tell us a little bit about what investment as a service is and what embedded investing is.
Thank you, Benjamin. So yeah, what is investment as a service? So investment as a service enables brands to embed regulated investing to their customers. So it delivers secure, regulated investment capabilities through modern API-driven platforms. So the heavy lifting like custody, regulatory reporting, execution is handled via this secure API-driven platforms. And it's really lowering the barriers for some digital brands to offer investing experiences for their customers. So if you can go to the next slide, thank you. So here we can see that brands are forming partnerships and forming this ecosystem to serve customers' needs. And if you can see the first layer here, this is the customer-facing brands. So they integrate investments into their apps. We have several examples of digital banks here and non-bank fintechs. We have the case studies of these brands in the report if you want to read. But yeah, this could also extend to wider non-financial brands, actually. And if you look at, for example, like Southeast Asia, we have e-commerce or even ride-hailing app that already embeds many different products and services, including investments. So it's really interesting. It's not limited to financial services only. And then it's facilitated by the second layer here, the embedding investment platforms that sits in the middle. So these are the investment as a service providers. They provide the investment APIs, regulatory reporting, investing infrastructure, and connectivity as well to other service providers, such as payments, for example, or the KYC capabilities. And then at the bottom of the stack, they are the financial institutions like asset managers who create and manage the underlying investment products, which flow then through these customer facing brands apps. So this ecosystem of embedded investing, especially with the support from embedded investing platforms, is really making it easier for brands to offer investment products to their customers through familiar interfaces. So where does this all lead then over time? So over time, embedded investing will become more contextual. It will bridge the gap between savings and long-term wealth creation. So people's financial needs change throughout their life stages. So for example, here early on, it's about building habits, building confidence of investing when you're early in your adulthood. And then later, when people have earned and saved a bit more money, it's about growing their assets, planning for their goals. So we can start looking at products like goal-based and thematic investment portfolios, ESG thematic things like that. And some people, for example, like people who have worked in multiple companies throughout their career would benefit from things like pension consolidation, for example, helping them to access different pension accounts from different providers. And then eventually the focus then shifts again to stability, earning passive income and passing wealth on to the next generation. And I think one important thing to say here is that this doesn't mean each product only works at one specific life stage. Most of these products can be useful at different points in customers' life, but the difference is their impact. So their impact changes across financial situation. For example, like roundups or low risk money market funds could be a great way to build an investing habit early on. But if you're later in your career and earning more, things like roundups or money market funds probably won't move the needle very much, and it's probably not where you want most of your money sits. So yeah, like the question is already shifts from where can I invest safely to where would the bulk of my money work hardest. So I think embedded investing works best when it really meets customers at the point of need across this whole wealth journey, so that it could provide most holistic, more contextual insight to the customers. And furthermore, with the advancement of AI and open finance, it could make hyper-personalized investment guidance more accessible, more scalable, and affordable as well. So yeah, excited to watch this unfold. Thank you everyone for listening. Now I'll hand it back to Liv to chair the discussion. Over to you, Liv.
Thank you so much, Benjamin and Farah. Definitely a really great, thorough piece of research, and it was great time doing the report with you both. So we are now joined by James Holmes, Seccl's Chief Product Officer. So I think we'll probably kick off with a question to James. And, really to kick off, obviously reading through the research, it seems like there's a lot of good theories and a lot of good metrics there, but how ready is the market actually for embedded investments? And, can you actually start talking about how we're starting to see this become a core capability across various firms?
Thanks, Liv, and massive thanks to Farah and Benjamin for the presentation and all the work that they did on the report. Yeah, I think it's a really great question. I definitely think it is something that is becoming more and more dominant in the market. I guess it's also important to kind of recognize that this isn't necessarily like a new phenomenon. The retail banks in the UK have always wanted to augment their services with wider financial services offerings, whether that be wealth, insurance. But I think what we're seeing now is a different degree of digital experience that the newer players are able to offer. As we mentioned, Monzo, Zopa in the UK, Revolut, they're all adding these services as core parts of their offering. And I think people are now seeing this as part of table stakes. Alongside that, and one of the things that I think we're finding particularly interesting at Seccl is kind of when there'll be an emergence of maybe non-FS brands looking to embed investing. So I think we've already seen other parts of financial services get democratized by being embedded with non-FS brands. And I think wealth will be the next kind of frontier to fall. But yeah, I'm also interested, Liv, you spend a lot of time speaking to prospective firms about this. Like, what's your opinion on it?
Yeah, I definitely think it's becoming a really real proposition and real project. I think definitely in the past 6 months, it seems like there's been this like slight land grab in terms of launching investments, just because there's been this domino effect of, a firm in a certain segment hearing that their competitors really seriously considering this project. So I think people are really trying to get on board of launching this soon so they can amass that like loyal retail investing customer base kind of ahead of the competition. And obviously at Seccl, James and I work very closely with firms across the market, and it seems like it's really the tipping point now in terms of people launching this and really wanting the retail investor space to invest and invest well. So yeah, I guess definitely an agreement there. I think, Farah, maybe it would be good to hear from you in terms of, touching on the research, why embedding investing actually into the familiar journey seems to change how people engage with investments.
Yeah, thank you, Liv. So I think the big thing is that embedding investing into familiar journey changes customers' behavior because it removes such big barriers, right? It removes effort, like a huge effort, and then it removes fear as well. So when investing sits inside a product that people already use, already trust, it no longer feels like a big separate decision. There's no, as Benjamin mentioned, like there's no new account to set up, no unfamiliar interfaces to learn, and there's no moment of, where someone thinks like, oh, it's too complicated. I don't understand this. I'll just do this later. So that really matters, especially for people with limited experience or people with lower incomes, where confidence is often a big barrier. So I can share, like I've seen this market, like in Indonesia, where platforms like Gojek, for example, it's a ride-hailing app, enable customers, including riders and drivers, to invest small amounts in funds or gold directly in the app. And yeah, it makes investing less daunting as well for them, like even for low-income populations, because they already get paid in the app, so they can use the money in the app to buy things or to invest. So I think it's really impactful because then we can give the opportunity to this even like low-income people to build their assets over time as well. So I think it's really impactful. Yeah.
I guess in terms of reviewing those journeys with the firms that you interviewed, possibly Farah or Benjamin, if you could answer, like, was there anything surprising with those interviews when people talked about these journeys?
Benjamin, you want to answer that?
Define surprising. I think the key point is thinking about, how do you take out friction for customers? How do you make it easier for customers? I mean, sometimes friction is a good thing, right? When customers are taking sort of serious and important decisions. But actually, for most people, shifting at least some cash into investments is the right decision, right? There's a few people, maybe if you're very close to retirement, maybe you don't want to be putting all of your money into high risk assets. But for most people, actually shifting money from cash into investments is very smart. So it's really about thinking about how do you reduce the friction? How do you make it easier for people to do it? It's also thinking about things like behavioral science. So how do you make the default for customers the right option? So it's a little bit like auto enrollment for pensions. So, in the UK, we are automatically enrolled into our employers' pension schemes unless we opt out, because actually it's the right decision for most people to opt into their employer's pension scheme. And so in the same way, you really want to try and make people putting cash into investments it's the sort of almost the default decision, because today the default decision by most people is you put the money in cash because that feels safe, or you put it in property because that's what your parents did, and so on. And I'm not anti-property. There's lots of good reasons to invest in property, but typically to invest in property you need a larger amount. So I think what's really interesting is the effort and the work that firms are putting in. I think one of the things I was interested by is we framed most of the conversation so far in terms of retail customers, and that's right. And of course, retail customers are a big opportunity, but there's also an opportunity for companies, because there are companies that at times have cash, depending on what kind of business they're in, what their cash flow is, and so on. There are plenty of companies that are sitting on substantial amounts of cash. Perhaps they're planning to make a big investment into property or other assets. So for companies too, there's actually quite a big opportunity of moving money from cash into investments as well. So actually, that was one of the surprises to me was the focus of some of the brands that we spoke to on businesses as well as retail investors.
I just wanted to pick up on something you said there about auto enrollment, Benjamin, because I think lots of our customers who maybe haven't been embedded, but they've been wealth techs as their core business line are struggling with this challenge of converting cash savers into investors, and it's been like notoriously tricky. I think one of the things we're seeing is that's actually helping them is that piece around auto enrollment by adding like a pension consolidation journey. Like most people, even if people don't realize that they're investors, most people are investing through their auto enrollment pension. And once customers can get engaged with their pension through a digital journey that helps them understand like what investing is, it's actually much easier than I think to get them to try and move money out of their cash ISA into their stocks and shares because they've got a taste of it, they've got experience of it. And I definitely think it's a big area for growth is getting that pension consolidation journey right up front.
Definitely. I think one of the slight disappointments about the sort of UK's regulatory regime over the past few years is there was a lot of innovation in sort of British regulation 10 years ago, but open finance has kind of slowed down. We did open banking, which enables people potentially to see all their bank accounts, but at the moment it's too hard still for people to consolidate all their finances, particularly their pensions, as you say, together into a single place without using a professional financial advisor, which many people don't know how to do or worry about the cost of, and so on. So I think you're absolutely right. If we can help people get a more holistic view of their finances, it helps people think about what am I doing? Am I optimizing my money? And so it comes back to this sort of guidance and advice. I thought something you said earlier, James, about some of the banks was really interesting because my experience has been that obviously there's lots of super smart people within the banks and really trying to think about what's best for their customers. But there's also been this fear of upsetting the regulator or doing anything that would offend the regulator. And that's made the British banks very nervous about providing any kind of financial advice. And so we've had this unfortunate situation for the past decade or so where the banks have been not unreasonably very nervous of providing anything that looks like financial advice, which has led to the bad outcome of people just not getting advice or now getting advice from TikTok. And there's some really smart people on TikTok, and there's some other people who have not got your best interests in mind.
And I think we're getting a few questions on targeted advice and targeted support in the Q&A. So maybe you could talk about how this fits into the broader trends in financial advice, whether this kind of makes the advisor possibly more obsolete. Like, what does the future hold from the 11FS perspective, Benjamin?
Apologies, I just just muted myself to look at questions. So this shift is really, really interesting, and I think perhaps people outside sort of investing haven't appreciated the significance of this, because this limitation on advice and the requirement for sort of advice to be fully considered has made many, many firms very nervous of anything that sort of looks like advice. So any kind of sort of tips, guidance, generic recommendations, firms have really shied away from. And I think this really gives firms permission now to say, well, actually, for a typical person in their 20s, you should be thinking about doing this and you should be thinking about doing that and so on. And that's not advice, it's a broad brush regulation. And if you know your situation is different, or you can see a customer, or if a firm can see a customer situation is different, then perhaps you suggest actually, given your unusual situation, maybe you should speak to a financial advisor. But I think giving firms permission to give some targeted support, some guidance, is a huge step forward for consumers and customers. I think the second part of the question was about what does it mean for financial advisors? Is that right?
Yes, exactly.
So financial advisors have faced a challenge for a couple of decades, right? That manufacturing financial advice for individual customers is time-consuming and expensive. Obviously, technology is helping with that. It's helping a lot with that. We're seeing the development of better and better platforms for financial advisors. But they haven't really changed the distribution model, and they haven't really worked out how do we reach more customers faster, right? So how do you get individual financial advisors to be able to serve more people more efficiently, right? Because each individual financial advisor probably needs to serve 3, 4, 5 times more customers than they were doing 10 years ago if they're to sort of maintain their effectiveness. So I think there's a lot of work to do in the financial advice industry to modernize how financial advisors go to market, how they reach customers, and so on. And what we've tended to see is financial advisors have been a little bit disconnected from digital platforms. So they're kind of losing their route to market.
Oh, I think Benjamin might be frozen. James, did you have any takes on this topic?
Sort of golf
Yeah, I think.
course type relationships.
Oops, I think you cut out there, Benjamin. But
I did. Apologies.
we can cut to now James, who can obviously have his take on the advisor space.
Yeah, I think I strongly agree with Benjamin's points. I think there is always going to be a place for an advisor or some form of human connection when you're dealing with money. I think people, especially as they're either entering retirement or they have large sums of cash as they're kind of entering the next stage of their life. Whilst I think it's great if you can build systems that can help get to the same outcome as an advisor. I think that's totally possible over the next 5, 10 years. I still think people want the benefit of sitting down and speaking with a human face to face about what's going to happen with their money. And so, no, I don't think the advisor will become obsolete. I think they'll become more important than ever. But they should be able to manage a broader customer base, have a better digital journey for their customers who do choose to go with advisors. And I think we will see more of a spectrum of guidance, hopefully through targeted support. I think it kind of remains to be seen how successful that will be. But I'm hopeful that what we'll end up with in 5 to 10 years is advisors that can deal with more customers, with a much better digital experience, and then a much broader access of guidance journeys where customers can make smarter decisions with their money without the need of having to speak to a financial advisor.
Perfect. Thank you. And I think we're getting a few questions as well around the topic of implementation and what kind of separates a good launch of embedded investments versus others. And I think specifically we have a question from the audience around, for more of an incumbent brand, what's the hardest organizational shift required to make embedded investing real? And if perhaps, James, you can share more insight on where you see partners struggling the most. And that could be anything from governance, API maturity, or commercial alignment.
Yeah, I definitely think we're seeing more of the incumbent providers look towards this. I think the things that they struggle with are kind of a combination of what you talked through. Typically the kind of governance frameworks of these organizations is more stringent, tighter in terms of the amount of hoops that people have to jump through. But I think there's a lot of kind of top level strategic alignment with embedded investing, and I think that's the kind of the first hurdle. If you've got people at the top who are talking about the importance of this and driving it as part of their strategic agenda, I think they will find a way in which for it to happen. I think the kind of two things that are coming, I think, as views around how the reg model is shifting. I think previously the incumbent brands have been pretty strong on wanting to own the full customer journey. So everything from not just designing the investment platform, but also providing all of the core services, client money trading. I think people are getting a little bit more relaxed about potentially moving to a model where actually they're happy to introduce their customers to someone like Seccl, like Upfest, who is able to provide those services and then really provide the kind of thin layer on top. It reduces the regulatory burden, it reduces the oversight hurdles, and I think it's something that we're seeing more and more in the incumbent brands. And I think the final point is just around the technology. You still have to make changes to the core banking tech stack as part of this proposition. That can be challenging, and I think more firms will see like provide front end screens out the box. So that's something that we're looking to do as well. Seccl can actually provide embeddable screens just to hopefully make that integration journey less painful than it might otherwise have been.
Perfect. And I guess, Benjamin, if a firm is looking to now launch embedded investments and they want to kind of look to what good looks like, when you were looking at the case studies and choosing which case studies to include in the report, what do the stronger examples have in common? Is there anything they put in place that kind of allowed them to succeed in the space?
Farah, do you want to take that one?
Yeah, thank you, Benjamin. So I think from the case studies, we can see that these firms really make it easy for customers to invest. So they really remove any sort of barriers, any large barriers. For example, like you don't have to make new accounts. You don't have to like go to this onboarding process. So it's really making it easy. They're really making it easy for customers. So investing is being kind of like a one natural flow into like their daily money management. I think that's it's really what shines, I think, in the case studies. And the other part is the involvement of like some educational content. So there are educational content, so customers can really learn how to invest. They can start small as well, for example. So I think really part of making it easy for customers that's really shine through across all of the case studies that we put in the report.
One weakness we sometimes see is sometimes in sort of embedded investing is deployed as a separate tab. Now, obviously, it makes sense to have it as a separate tab because it's a different thing, but sometimes it's not integrated with the savings, and you can't kind of see the investments and the savings together, and that can be a gap sometimes.
And I think there's a few questions again on I can see in the Q&A section around the responsibility of the firm who is launching embedded investments to have a responsible place in terms of like directing retail investors who may be novice into the right places. So perhaps, James, you might want to speak to like the types of investment offerings that end customers and retail investors may want to see firsthand, and how not only Seccl, but how these firms should kind of think about opening up this process and launching this type of project.
Yeah, totally. I think it's really important to try and think about the target market that you're trying to offer your services to. Like, are you particularly trying to target first time investors? If so, you should have quite a different proposition to if you're trying to target experienced investors or those who are more familiar with financial concepts. And I think one of the things we're seeing is firms choosing to build kind of multiple journeys that help, and customers can kind of self-select which one they want to go through in order to make sure that they find something appropriate. And it might be for first-time investors, you spend a lot more time talking about risk, volatility, what a fund is, for example, what's an ISA, what's a pension. Whereas for the experienced investors, you might give them like free reign where they can pick out of 5,000 assets which ones they want to invest in. And I think it's really important to have that blend, and also have customers be able to graduate up the different levels, so that once they have got a better understanding or they are more confident. But I think one of the things we definitely seen is that if you go to people who are first time investors with that really complex kind of search bar, it's completely overwhelming. People are spoiled for choice. It's not something that they want to do. And I think it's really important to think about exactly who you're targeting when you're designing that customer journey.
And Farah, I know you mentioned education, so maybe you want to kind of delve deeper into how firms can prompt their end investors to educate them in terms of like what routes to take, maybe from a UX perspective or testing perspective as well.
Yeah, so I think what's really useful, I think, will be like behavioral nudges. So for example, like I can like, for example, Monzo gives kind of like a nudge. So for example, like, oh, you only spend this much for like this month, like you can save this amount of money and things like that. And also making it easy for investors. Like for example, like I use Monzo's roundup investment as well last year, so it didn't feel like I was doing anything. But then at the end of the year, I see that I've saved, like I've invested some decent amount of monies, and like it's really easy for me to use that, and it's really easy for me to learn how to do that. It could also be from like educational, like quizzes or like bite-sized educational content, and then it could also be from what is it, like ready-made portfolio. So based on the risk level, you can present kind of like, okay, if you want like a little bit more low risk, here are the portfolio for you. A bit like medium risk, this is portfolio for you. Higher risk with higher return, this is the portfolio for you. So it's really making the investor easy to choose which one they want to do first.
Okay, great. Benjamin, did you have any comments?
Yeah, I mean, there's a whole series of sort of behavioral nudges that firms can give to customers. And there's quite a lot of sort of academic research, and there's a growing number of firms that are starting to put that into practice of trying to understand what are the ways in which we can make it easier for people to invest, we can make it more likely for them to invest. You know, James had a great one there of don't overwhelm people with complexity, right? For novice investors, you really want to give them a relatively straightforward and simple choice of a few investments. It's a bit like if you go to a restaurant and there's 150 wines on the menu, And you have no idea which, if you're not a wine connoisseur, you have no idea which wine to pick, and so you just default. So it's making some of those defaults really easy, encouraging people to do the right thing, nudging them, reminding them, as Farah was saying. But there's a whole science behind this, and there's a lot of sort of academic work that's gone into working out what works. And now what we're seeing, which is really exciting, is firms actually starting to put those into practice and deploying those kind of nudges to encourage each of us to do the right thing for our situation. Obviously, that needs to be very carefully done, and it needs to be done in a sort of regulated and controlled way. But there's a real opportunity to help people do the right thing for them.
Perfect. I think we'll end with one final question before moving into the Q&A. And I think really in terms of like getting this off the ground, technically or culturally, what do you think is needed for the next phase in embedded investments for this to really take off? And what role do you see non-financial platforms having in this real takeoff? And perhaps, James, you could finish off.
Yeah, I mean, obviously it's a Seccl powered presentation, so I would always point towards having really great infrastructure that enables you to embed these propositions. I think it's having the right mindset in these firms and the right strategic focus. I think there's bags of that, and now this is really about an execution challenge for these businesses about how they balance all their different priorities and focus on this. I think to answer your second question on how non-FS brands will play a part, I definitely think it will be something that will come to the fore. I think Farah mentioned that typically in parts of Asia, like they're already further ahead of this, where they have non-FS brands moving into the investing space. And I suspect that the UK will follow. Like why would Uber, for example, not have embedded investing for or embedding savings propositions for their workers? I definitely think there is demand for that. So yeah, I think it'll kind of be seen about the pace that they adopt it, but I think it's definitely coming.
And any final thoughts from you, Benjamin or Farah, before heading into Q&A?
I think James summed it up nicely. It's a lot about trust, right? Who do you trust? And I think, the Uber one is an interesting one, right? Does your average person trust Uber to manage their investments? Maybe. Does somebody who works for Uber trust Uber and already have a financial relationship with Uber? Absolutely. So yeah, I think it's really important to think about who's your audience, who are your customers and what's right for them.
Perfect.
I think, sorry, just to add to that, it's also important who you partner with. So for example, like Uber or any like non-financial brands usually have like less capability or like less trust in terms of like managing people's money. But then if they say, hey, we partner with this big investment IaaS platform or like with this asset managers, then people can like build more trust with that.
Perfect. Okay, thank you. So we've tried to obviously put in a few of the questions already throughout the discussion. A lot was actually on the ethical elements and how to actually prompt retail investors to do the right thing when they're properly educated. We have a first question again around targeted support. And basically this attendee is asking how embedded investments will prompt investors how the technology will allow investors to kind of get rid of their cash hoarding? Like how will the behavioral change move them from cash to investments?
The wonderful thing about people is they're incredibly diverse, right? People hoard cash for all sorts of reasons. They put it under mattresses and so on. Some people just genuinely believe that their money is safer that way. Some people don't necessarily understand the impact of inflation and how that gradually eats away at the value of their cash and so on. So there are some people who just incredibly hard to reach. Maybe you're never going to reach them. But there are other people who perhaps haven't thought about it. Perhaps they're being lazy. Perhaps there's inertia. Perhaps they haven't got round to it. They haven't quite been bothered. And for all of those people, if you can reduce the friction, reduce the barrier, make it that bit easier, you can nudge them across if you can. So I think there are huge opportunities with many people, and targeted support just gives firms more license, more ability to sort of reach out to them, encourage them to do the right thing. Where up till now, a lot of banks have been so worried about another mis-selling scandal and getting in trouble with the regulator that they've sort of backed away from doing it, even though they know it's the right thing to customers. They sort of backed away from it because they don't want to take the blame or get in trouble for saying the wrong thing.
James, did you unmute? Did you want to
Yeah,
add
sorry.
something?
I was just gonna add to that. I think I totally agree, and I think there is definitely a risk that we're target the targets of support could end up with customers who maybe shouldn't be investors. But I think in reality, and it's really interesting interviewing people for Seccl. Like one of the things we ask is are you interested in investing? And the number of people who have become interested in investing in the last year, they've previously thought that if they just are frugal with their budgeting and they save money and they put it in a bank account, like that is financial health, or they're going to do well with their finances. And I think it's really interesting when you start to understand that people are becoming having this awakening. People who do have a like material amount of money in cash who are still not getting access to investing. Um, and I've got everything crossed that target support can be a good kind of force for good in terms of ensuring that we do reach the cash hoarders, as the question puts it.
Nice. And Fair, I think we have a question mainly for you. So we obviously talked about non-FS brands looking more deeply and especially in the Asian countries at embedded investments. But why do you think the average consumer is now starting to trust their consumer brands more than perhaps their financial service institutions historically? And what should a firm be looking at in order to know whether they have a good, strong customer base to launch an embedded investment platform?
Thank you, Liv. So I think what's making it really good is that uh, let me try to think. So um, so these non-financial brands have like already lots of customers that use their brands, right? And then they can, for example, like if you see in Asia, they're already embedding, for example, payments as well. So for example, like in an e-commerce platform in Asia, there's one that has already a digital payment system embedded as well. So for example, like if people want to like people buy something or purchase something and they get a cashback, for example, it's saved in their digital payment there. So then people can use that digital payment to like purchase more things or like to invest as well. So if they add investment in there, it's already like in their app. So it's not like a new thing to add again. It's already in there. So they're so it's really flowing in their journey, like it's already in their app. Sorry, your the second part of the question.
In terms of what like they should be evaluating to know that their customer base is strong enough to launch this embedded investment platform. So what would give a firm confidence that they would have a good uptake in this new product?
I think we need to see kind of like the market itself, how the market is responding to similar propositions as well. Benjamin, do you have any thoughts on that?
Yeah, I think you also need to think about how far your brand will stretch, um, because trust comes from familiarity. So for firms like, let's say, Amazon or Apple or Google, that many people in the UK deal with every day, that familiarity builds a certain level of trust. Now, does that mean you trust it to manage your investments or as a way to manage your investments? Maybe. But so for each brand, there's this question of, okay, can we stretch to that? So if you're an insurance brand or you're a banking brand or you're a payments brand, stretching to investments is very easy. If you're a bit further away from that, it's a bit more of a stretch. I think what James was saying about Uber is a really, really interesting one. Like for the Uber's workers, its employees, and I know there's court cases about whether they are or aren't employees. That's a really logical thing. For people who just ride on Uber, well, you've got to be a bit of an Uber fan, perhaps, to decide, okay, I'm going to invest through Uber. So I think for each brand, it's thinking about how far are our trust customers going to trust us, and also, there's a number of strategic opportunities in front of us. How good an opportunity is investment for us, given our brand, given our customer relationships. But if you think about it in the UK, there's brands like Sainsbury's, Tesco, Virgin, etc., that in the past people have entrusted their finances to. I mean, what has Virgin got to do with money? Well, enough to become a brand and a bank, right?
Yeah, definitely. Thank you for that. I think we're at time. So unless we have any final comments from the panel, obviously thank you very much for uh, partnering with us on the report. And I think this was a really good conversation for those people that are looking more deeply at embedded investments. Thank you.
Thank you.
Thanks all.
Bye. Thanks.